Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome, everyone, to another episode of Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with the podcast, my guest and I will cover every angle of real estate, from interest rates to the economy to what's happening in Washington. Anything that affects our real estate market, we'll cover, dive in on obviously in the Washington, D.C. metro area, but we will talk more, in terms of the national perspective as well as kind of the local D.C. metro area and some of the other metropolitan areas and so what's taking place. We're going to dive deep into, the economics behind what's taking place in the real estate market, interest rates, the Federal Reserve, and some. We actually got some great topics to talk about today. We've got the Fed came out with their minutes, basically where they're now are back dovish again. They're not going to planning on touching interest rates until probably 2016 at this point. It's literally comical how we kind of week after week kind of see this back and forth from the Fed's comments. We also have Mr. ex-Fed Chairman Ben Bernanke applied for a mortgage and was denied. A lot of a lot of irony in the low interest rate environment that not even the ex-Fed chairman could take advantage of, right? I think that's pretty telling as to where we are in the real estate and mortgage industry at this point in time. So we'll jump into that a little bit. Joining me on our panel as he does each and every week is Louis Camerosano. Louis is often cited in the media as a real estate industry expert. He's cited in the Wall Street Journal, Forbes, Fox Business, U.S. News, MSN, and numerous others. Louis, how you doing today?
Ryan, I'm doing grand. How are you?
Great, sir. I'm doing well myself. So
Excellent.
Last week we spoke. We talked obviously a little bit about the Fed. Obviously, the Fed is back at it again. The shenanigans continue. We typically at the top of our podcast kind of go over the economic things on the economic calendar that's taken place over the last week. So let's kind of highlight what's taken place. We had initial jobless claims. For those of you that haven't paid attention, they came in lighter than expected, 287,000 versus the estimated of 295,000. Continuing claims were 2.381 million versus an estimated 2.410 million. Granted, this is basically a good reading, they would say, and would help, it should help stock market move higher on these readings. Now, with all this being said, I think there's some major disconnect, and all the more reason why I feel like that these economic reports are completely made up. Okay, I think that they're just, they come up with these numbers and they post them, but there's not even a hint of accuracy in my opinion. There's a disconnect because there was also a JOLTS report that came out, which basically the JOLTS report showed that there was a record amount of job openings that have been unfulfilled. So if we don't have, a lot of firings taking place, and there's a ton of these unfulfilled positions, what's really going on, Louis? You know what I mean? Like, it wouldn't make sense that we would have a record amount of unfilled positions, but then not really too many firings taking place at the same time. I just, week after week, I get more and more confused and sidetracked, but about all these information they put out there, which is pretty much what they want you to be, is completely confused.
Right. The distortion, Ryan, is from the part-time jobs that show job growth, because sometimes one person will have two jobs. And then also the reason initial jobless claims are down, or not only do they have fewer people left to fire, they've also stopped firing people and moved them into part-time, so that doesn't count as a firing, and people aren't applying for benefits. So the whole job market is distorted. The more important numbers as we focus on to show the health of the labor market are wage growth, the types of jobs being created, and the labor participation rate. And all three, the wage growth is down, the types of jobs that are being created are service sector, part-time jobs, and the labor participation rate is down, and the food stamp number of people on food stamps is up. That gives you the snapshot of the health of the consumer. Not what consumer spending is, because that's credit-based spending on cars and things and even necessities, and they also ratchet up consumer spending on things like insurance and energy, which they claim is good for the economy. It's not. It means people have to spend more money on things like health insurance and energy costs. So the numbers that they give you, they may conflict, they may paint a rosy picture, but if you look at the actualities behind them, they don't. But that doesn't change them from going out and touting them or interpreting them any way they can. And if you see, Ryan, you just mentioned what's going on with the Fed is classic. I mean, they have done a number on trying to give a snapshot of what the economy is based on what their Fed policy wants to be, rather than basing their Fed policy on how the economy is. They just called their own bluff on raising rates one more time. They've been saying, oh, we're going to have hoily, accalmaudative monetary policy and then for a considerable time. And then they started backpedaling and saying, oh, the economy is getting stronger and we should be able to raise rates soon. And when we raise them, Ryan, when we raise them, we'll raise them fast and furious, quicker than you can imagine. And the stock market goes into horror. Oh, no, that's going to happen. And then they come out, oh, well, we didn't mean that. It's data dependent, not date dependent. And we talked about 2 weeks ago, Ryan, remember? We saw how Dudley and the rest of them were already backpedaling. The Fed President Dudley of New York was talking about how the dollar might cause problems with inflation, interfering with their inflation plans, and might cause deflation. They all said all this 2 or 3 weeks ago, and we covered it in our podcast about how the Fed was already backpedaling from that. You had Fed's Meister saying we want to change a considerable time period. You had Nairana Kocherlakova talking about how we don't have enough inflation. Charles Evans talking about how he's not comfortable raising rates yet. So the FOMC meeting minutes shouldn't have been a surprise. These guys have been out there yakking about backpedaling on raising rates. But then what do you get yesterday? Fed Williams goes out there, and he's talking about raising rates again. So you see, right after they put out the meetings, now this guy Williams from San Francisco, he's a dove. He's like yelling. He basically encapsulated everything that the Fed said, because he said basically the Fed can do anything, and he basically said nothing. He said the Fed could raise rates more quickly if the economy starts to overheat. But he did not rule out selling assets if needed to keep inflation under control. He sees first rate hike in mid-2015. But if the economy slows significantly, that could prompt the Fed to delay rates beyond what is currently expected. So they make you think that they've got two options. They're either going to be hawkish or they're going to be dovish. If they're hawkish, they're going to sell assets and keep, they're going to keep inflation in their check. Or they're going to be dovish and keep zero interest rate policy. What they don't tell you, Ryan, is that part of being dovish may be they may have to flip the switch and turn on QE again. And they've started this QE nonsense and zero interest rate policy 6 years ago, and every year they tell us the economy is going to improve, and when it does, by golly, we're going to shut down the QE and we're going to raise rates. They've shut down QE, but they started again. And they have never raised rates in 6 years. And what people don't understand is the Fed car goes in one direction. Yep. They claim they're going to reverse course. They will never sell out. They might one day put in a little credibility boost and a credibility interest rate hike, and the markets will freak out over it, and they'll never do it again. But they're not going to sell assets. They're not going to sell $600 billion a year worth of mortgage-backed securities and treasury bonds. They're not going to reduce their balance sheet. They can't, Ryan.
If anybody is wondering why we really haven't had significant volatility in the stock market, it's because Wall Street has become so they focus so much on what the Fed's going to do and say. They all know that this is just Fed speak, that they're not going to really reverse course. They all know that, which is why you don't see these huge dips. You get a pullback, and then a couple days later it'll be right back where it is. You said something interesting about what the Fed continues to dwell which is data dependency, right? And they don't feel like they have to do anything until the data shows otherwise. What's interesting about that is that regardless of what data comes out, Lewis, it's all about the interpretation of the data by the Fed, right?
What about the data yesterday? after everybody was totally thinking that the economy's now in the dumper, international monetary policy says growth is gone, the Fed is talking about, oh, hold on a bit, then you get this glowing jobs report. Of course, Reuters jumps in and says U.S. job claims fall, point to labor market strength. Well, what does labor market strength mean, Ryan? Well, maybe the Fed can raise rates, and maybe they're going to change course. No, they're not. We just talked at the top of the hour about what people lose. The initial jobless claims number is almost meaningless. But people think that they hang on that and they say, well, if that job number is good and the economy is overheating, maybe the Fed will raise rates. It's not going to happen.
Yeah, and this is more back to the point of it's just nothing but cheap talk, and it's been like that for 6 years now. If they were really dependent on making this stuff happen, they wouldn't talk about it. They would just do it. And the fact that all they can do is talk about it tells you that nothing's going to change, and nothing can change, Lewis, because as we've mentioned, there's no wage growth. The labor participation is terrible. The economy, Ben Bernanke can't get a loan, a refinance on his own house, okay?
Did you see Buffett the other day saying getting a mortgage is a no-brainer? Yeah, if you can get one. And what kind of show talk is that? We talk every week, Ryan, about if you can get access to free money and buy a house, go ahead. Lock in that low rate forever. But no one can do it.
I wish Ben Bernanke would listen to this podcast. Ben, I have some good advice for you, buddy. Go to the local credit union, okay? Because I'm pretty sure that they would love for you to be a member of the local credit union there, and you could probably get your refinance done knowing you're pulling in $250,000 per speech right now, okay? Now, it's interesting, and I always question how and why these stories break, right?
Exactly.
And people are actually questioning that there's some sort of conspiracy theory behind this whole thing as to, okay, was this Bernanke's move trying to refinance right now, because he's expecting interest rates to rise, right? Or
are they trying to create political pressure to loosen lending standards if even the exalted mystical leader Ben Bernanke can't get a refi mortgage?
That's exactly what my second point was going to be.
Oh,
right?
I'm sorry.
If he can't, no, you're fine. If he can't get a mortgage, then obviously the system's broken, right, Lewis? We've got to start changing, the whole CFPB and everything that's been implemented, Dodd-Frank, all this stuff. We got to start ripping it back down because
housing is gone.
Right. Housing.
You don't even see the word recovery in the CNBC news stories anymore. They were touting recovery. And then they started scratching their head saying, well, why isn't there not a recovery? Now they just say how bad things are, that no one's buying houses and prices aren't rising.
Well, what's interesting is that I just got done reading an article on RisMedia.com, and it was by Margaret Kelly. Margaret Kelly is the Chief Executive Officer of RE/MAX, okay? Mm-hmm. Now, what is the headline? Rising interest rates won't slow down all buyers. Let me read you her first paragraph. Many of you are seeing it in the field. Low inventory, houses flying off the market, and a groundswell of demand from buyers. As a result, home prices are steadily increasing. Combine all those factors with signs of strength in the economy, and you have a recipe for another market change, higher mortgage rates. Margaret, to be a chief executive officer, you are awful confused because this is not what's going on. And once again, this goes
back.
But
she wants to go on.
This is what you want to go on. This is that you have an objective, which is to push, more agents into the real estate industry to try and get, create that positive consumer confidence out there that more people want to buy houses. Now, it's not a problem of people wanting to buy houses, guys. It's a matter of they can't get mortgages to buy houses. They can't sell their house because they're upside down in their current house. They can't buy a house because they don't have a job.
Right. They think they can just, through hype, drum up demand, and the demand materialize like you're marketing pet rocks. And everyone will go out and pay $2 for a pet rock or any other consumer item. You cannot get people off the fence, as they try to say. Now is a great time to buy a home if you have no money and you can't get a mortgage, or you don't have a good job, or you've just lost your job, or you have 2 part-time jobs, or you haven't gotten a raise in 5 years. You can't, or your home is underwater, or your home is not underwater, and as you point out constantly, you don't have to be underwater to be unable to sell because you have to be pretty much ahead of the game before you can sell your home after you have your selling costs.
Right.
To be able to afford to do a move-up.
It's, and I can take her third paragraph, takes it a step further. While some industry watchers predict the rising rates could stall the positive momentum in housing's recovery, I tend to agree with the school of thought that says the rebound will continue despite upward ticks over time. Really? Huh. That's interesting. Because all the word on the street from all the other agents that I know are saying that stuff has come to a crawl, right?
And stuff has come to, I'm seeing price reductions here in the Northeast every 2 or 3 months. Houses starting at $659, going to $629, going to $599. Some of them going down to $499.
Well, and and the other thing that I'm seeing, Lewis, is that when typically
better
when you
act
have
soon.
Yeah, well, when typically the market
before the next price reduction.
Right. Well, when markets are moving up, like let's just say somebody prices at $425, and then the next house is identical, basically going to look completely the same on the inside. That next house might list for like $5,000 more than that house did, right? But now what I'm seeing is those houses are actually listing for $5,000 or $10,000 less than that house, right?
Right.
They
Exactly.
understand that in order for them to stand out, they not only have to look like a turnkey home with potentially staging, professional photography, and all the other things you need to do to get your house ready to sell and to stand out, but you have to price beneath the other guys that are on the market.
And you also don't want, Ryan, 3 price reductions under your listing.
Correct.
So you start $5,000 under the other guy who's already reduced his house 2 or 3 times.
Yeah, because, it makes sense, right? If an agent goes and they see, hey, this other house on the block, which is exactly like yours, been on the market for 120 days and they've reduced 4 times, why would you want to price over top of them?
Right. You price 5 under, and it's a nicer looking house because it's red. That might have a better chance of selling. But, what also might happen, Ryan, is that house might not sell either. If the stock market sells off, which is the last pillar of the so-called economic recovery, who's going to be able to buy houses? A lot of people are taking advantage of the wealth effect. Their stock portfolios are up, so they think they're in a good position to buy. You have a crash in the stock market, those buyers go away too. People start to worry about their financial future. Because what they've done, Ryan, through this entire financial engineering of zero interest rate policies and QE, they've tried to make people think that stock market crashes are once in a lifetime, as are housing always goes up, and that little housing problem we had in 2008, who could have seen, that was just a strange thing, and that's gone, don't you see? House prices have gone back up, so everything is fine, get back into the game. And that's what they're desperately trying to hold on to, is that everything is fine, and that the people who say things aren't fine, people who say that we have too much debt, they came out with the new debt numbers. Now they're saying, the Tea Party's crazy. They better come up with another argument because the federal deficit's under control. Yeah, if you just take stuff out of the deficit and say it doesn't count, of course you can show a lowering deficit. Then they attack gold constantly, Ryan. You do see that. They don't want people to think about that. You have CNBC, gold going to 850, Ned Davis saying gold to 600. You've got this Barry Ritholz guy at Bloomberg, articles, how low can you go? And then characterizing people who like gold as world is ending types. That's like saying that people buy stocks are degenerate gamblers. Why do central banks own gold, Ryan? Because they think the world is ending? So they try to characterize people who see what's going on, who see deficits, who see endless zero interest rate policy, who see money printing, who see what happened in Japan, see what's happening in Europe, see what's happening in the United States, no growth, and yet 100% central bank intervention. And then when someone says, well, geez, I might buy a little gold, you are a end-of-the-world type tinfoil hat conspiracy theorist. You say, no, it's just prudent for somebody who might want to have precious metals in their portfolio outside the banking system, locked away in a vault and insured. How is that end of the world?
Yeah.
Central banks do it. And in fact, if you're such a huge fan of central banks and you believe all the nonsense they're doing, why do they hold gold?
Yep. And that's a question that nobody truly wants to answer, right?
Sell it.
Because
England sold theirs. Canada sold theirs.
I know.
We got Fort Knox. Get rid of it. Just open it up. You know what? Let anybody who wants to go in there take whatever they want.
Right. Yeah. I think everybody is smarter than that. It's just that they want to buy into the load of crap that everybody else is feeding them. And this has been going on forever. And I stick to my guns. Remember, I keep telling you, Lewis, I said, look, this stuff is going to drag out through the next election, right? Not on Obama's
You have. That's right.
I mean, I just see it. It's like, it's just the back and forth. We go, okay, the Fed's not going to touch rates at 14, then it's 15, then it's 16. Okay, well, great, now Obama's out of office. He didn't have to worry about it. He rammed his health care bill down to everybody's throats and did what he said he was going to do. You know, the whole hope and change thing. Now I can't wait to see what Hillary's going to bring to the table. But it's less about Hillary and more about the Fed, because guess what? This is the most massive Ponzi scheme that's ever taken place here. I mean, the Fed is in every single market known to man. They're buying up all the debt. They're in the stock market. They're completely controlling the interest rates. It's insane. And people are delusional to think anything different, because this is what's been going on for some time now. And there's no way getting out of it, really. There's not. The way to get out of it is not really getting out of it. It's just to continue to do what you've been doing, which is continue to push print. Now, how long can that go on? Lewis, you and I have debated this all the time. We don't know, because
in 2009 we said, they can't push this past 2012. We are 2014.
And I guess, as long as they can keep coming up with creative means, whether it's, funding or having other central banks come in and buying up our debt or bailing out, I mean, whatever they can call it.
There's always new ways to issue more credit. People turn 18 every day. There's debt forgiveness programs. There's programs to work off debt. There's larger credit lines. There's new monetary products. There's more QE.
Well,
so that's what we've underestimated, their ability to issue new credit.
Yeah, well, now that Bernanke, couldn't get a loan, maybe the Fed might start doing some subprime lending, right?
Yeah, well, what do you think, Ryan, that if someone can't get a loan, what they never say is we need to reduce the amount of debt out there. So if Bernanke can't get a loan, maybe that's a good sign. Maybe lending shouldn't be happening. Maybe we should allow people to restructure, rebuild their savings, and not buy a home if they can't afford it, not buy a car if they can't pay almost all of it in cash. That is anathema to the whole Ponzi scheme system of credit. They want credit to flow. And what they did was they made sure it flowed to themselves first. So they can buy up all the assets. They can get the homes cheaper. They can buy stocks and make a lot of money in their portfolios. And now they claim, well, we got to show a little credit to everybody else. And they did. Subprime auto, the average person has the ability to get whatever they want on credit except a house. They can get a car. They can get a credit card and go buy junk at Walmart, Target. They can buy whatever they want. They can get themselves into debt as much as they want. They just can't buy a house. And that's bothering the central planners. And I think one reason they don't want them to have, but there's probably a reason, Ryan. The problem that the housing bubble caused for the banks was they had to actually be stuck with physical inventory. So they try to get out of that by saying, well, we have it, but we don't really have it, but we're going to count the money that we would get from the mortgage as being on our balance sheet, and then the Fed's going to buy the mortgages. That makes it very sloppy. They don't really want to be involved in having physical assets because they're harder to and they figured out a way to monetize them and to buy the mortgage-backed securities. But they'd rather get away from that and make credit. That's why they like the carbon tax. Because just by existing, you owe money, and there's credits to be traded, and I think that's where they're trying to head from. They want to get away from. That's why they want digital currencies. They want everything to be digital, so they just control the master computer where they can push buttons and say where money goes and comes from.
Yeah, but at the end of the day, Lewis, we all know why interest rates can't rise, though, right? The real reason
please go through all the reasons, Ryan.
Well, the number one reason why interest rates will not rise in 2015, 2016, 2017, 2018, 2019, 2020, and on is because the government can't service the debt at a higher interest.
Right.
They can't, right?
Nope.
So is
the government really reducing its deficit? Even if on an annual basis, they still owe all the money for the unfunded liabilities. And the deficit is a deficit. Whether it's $600 billion or $400 billion, you still owe money.
And so look at it this way. Even if the Fed wanted people to be able to get mortgages, right? Even if they did, the low interest rate environment is making it conducive for banks to take the money that they're borrowing at next to nothing and keep it floating into the stock market. They have no reason to want to lend to anybody. But they can't go back and say, hey, you have to lend this money out to people so they can buy homes. No, because if they wanted to do that, they would just raise interest rates up. If they raised interest rates up, banks would automatically start lending back to consumers because it would make sense for them to take the risk to do it. But why can't they raise interest rates up? Because the government can't service the debt at higher interest rate levels. That's the number one.
There's another reason, Ryan, too. The reason the government makes any money on taxes is because of the economic activity that takes place of consumer spending, which most of is financed through credit-driven purchases, which are in turn driven by low and zero interest rate policy. So the stock market and the economy themselves are also addicted to the low interest rates because the bulk of the economic activity comes from people borrowing money to spend on stuff that they could otherwise not afford. So if you were to cut off interest rates and raise interest rates, and now cars, you couldn't get a car unless the loan was at a normal interest rate of 8 or 9%. People couldn't afford them. People couldn't buy them. So all that activity that results from buying and selling cars and consumer spending would go away. The stock market would go down too, because if interest rates are higher and the stock market started to crumble, people would say, well, it's a lot safer if I can put my money in the bank and get 4 or 5 or 6%. The reason people have money in stocks is you have to be an idiot to have money in a bank account. Not only forget bail-ins, even if it was 100% safe, you're getting less than the rate of inflation and interest. So that's another reason they want to make sure that the money flows into the assets that they own, which are stocks.
Right.
So the stock market and the government are the two main reasons why they can't lower interest rates.
Absolutely.
I mean, they can't raise interest rates.
Yeah, and the whole reason why, if you guys have been listening to our show, why 1 week we're talking about the Fed saying that they're going to raise rates starting in 2015, and then the very next week they're saying, we're not going to touch it to 2016, and then the next week they're talking about, hold on, the data looks like it's coming in better than expected, right? It's hilarious. I mean, you guys have to understand that where we are now is like the point of no return, and the only thing they know how to do is much of the same, which is continue to keep the rhetoric, keep people confused, start talking more about the Ebola virus than anything else, right? Because that'll buy them 3 or 4 months. We can start talking about all the international catastrophes and conflicts that are taking place because that's just the sideshow. That's the circus that's taking place to take the limelight back off the economy, back off the Fed, back off the president, right?
Yep, and two mistakes that I made in forecasting, and I think you were in agreement with me, was that rates had to rise because if they were serious about stopping QE, then we figured who would buy the securities? Rates would have to rise. There's no demand if the Fed was 70 to 90% of the market for newly issued treasuries, that rates would rise and we'd have a problem. Well, wrong. They figured out a way to keep rates low, and now, without QE, supposedly, so rates are going to stay low, and that's because, as you mentioned, they have to stay low for the two reasons you mentioned. The entire economy, the stock market, and government spending and financing is dependent upon keeping rates low. And the other big big call I made was saying that gold and silver would rise this year. I thought silver was going to be $30 and $32 and gold up to $1,500 just because of the economic situation with the amount of credit available, how the Fed would continue to keep rates at zero and run the entire year at QE, even though they're tapering, they were still printing. They still ended up printing almost $1 trillion in calendar 2014. But we saw, starting in 2013, the naked short selling and the smash downs of gold and silver by the bullion banks. So they did it again this year. Now, people are saying that may run out and eventually they won't be able to do that anymore. But I say, having been through the last 5 years with you, Ryan, talking about when we think the game is up, they always manage to pull a rabbit out of the hat. They manage to keep interest rates low. They manage to keep the Ponzi scheme going. They manage to suppress the prices of gold and silver. So, like you say, 2014, they'll get through this election. Who could have thought they would have done it? They managed to keep the stock market high and inflated. And, if the peasants don't get their homes, so what? If they don't have good jobs, we can say there's job growth, even though people don't think so. And there's been polls out, Ryan, saying 70% of the people think we're still in a recession. But the media tells you we're in this massive recovery. Job growth is accelerating. Stock market is higher than ever. Proof of a recovery. So that's what I've learned, Ryan. And you've been teaching me that they could keep this game going a lot longer than you think. And they've proven it. That doesn't mean that the structure is sound. It just means they managed to keep it from wobbling, or even people from seeing that it's wobbling. Eventually it's going to collapse. And I think everybody knows that. But their ability to keep it standing is pretty phenomenal.
Yeah, and if you've noticed, anybody that talks about the Fed and the Ponzi scheme that's taking place, they don't exist for longer than a day. They get buried, right? Like it's not news. Now, if Wall Street were to find that there's somebody else, a hedge fund or somebody that's running a Ponzi scheme, they would be front page news for months. Madoff was front page news for months. But
we know the name.
They're doing correct. But the Fed is looked at completely different. They're looked at as like they're the savior. They're the savior.
They're supposed to manipulate markets for our benefit.
Yeah, don't you see the stock market? If the Fed wasn't here, it wouldn't be there. Yeah, well, I get that. I get that. And do you understand that it's basically illegal artificial manipulation? That's what it is.
Yep.
It is. That's exactly what it is.
100%.
It should not be allowed.
Conspiracy. The fact that they fix rates, it should tell everybody they manipulate rates. You think they only manipulate interest rates and they allow every other market to be free?
What would happen if businesses were price fixing, Lewis? Right? Like, I'm pretty sure they'd be considered evil, right? And somehow the Fed has managed to not have that type of I don't know what the word I want is, but
credibility.
They're able to remain credible with all the nonsense that they've done over the last 6 years. It's basically, how many times?
Even if they're allowed, Ryan, even if they're allowed to do what they do, they still have no credibility because they keep saying they're going to do something and they don't do it, which is raise rates, which they shouldn't be involved in anyway.
Well, Lewis, if I owed you money and I kept telling you that I was going to pay you next month, and next month, and next month, and next month, by probably month 3 or 4, you're basically done with me, right?
After 6 years, Ryan, you think I'd still be dealing with you? And everybody else, and you'd be lending money? Reminds me in Mean Street with, what's his name? Robert De Niro. He's, I lend money to people left and right. I never pay them back. That's why no. And he goes, and you're the only guy who still lends me money. You must be in. He gives him a harsh name. Right. It's obvious, even on the street. You're right. When you get to the point where someone is a deadbeat, they're a deadbeat, but somehow to maintain that credibility is astounding.
And
especially when you look at Yellen, she doesn't even inspire confidence. She's up there talking in her Brooklyn accent. She doesn't say anything. She's not inspiring. She doesn't seem to have a grasp on things. She talks about the committee, and people are sitting there taking notes.
There's nothing to take. Yeah, let me give you reporters something to think about here. There's nothing to take notes on because you can already write the story ahead of time. You know exactly what's going to take place. And see, I'm convinced they didn't want a Fed chair to come in there that was going to be inspiring. They wanted somebody that was going to be a robot, that was going to look at the paper that they gave to them before they go and speak and just read it right off, not really have any, legitimate answers to any of these things. And, reporters in media don't want to have backbones because they don't want the real answers to their questions, right? They don't want the real answers because the real answers are, we're in big trouble.
Well, if they want the real answers and they go for the real answers, they end up like that Luke Radinsky guy chasing people around with a camera because no one will give them access to an interview. If you want what's called a legitimate interview and you don't want to do ambush journalism, you have to suck up to them and say, oh, you're right. Oh, this model makes sense. I just have one slight question about this decimal point here. Oh, I see. That was a mistake. Okay. Well, thank you very much. And then they invite that person back because they've been deferential.
Right. And then all the other, the guy that...
And then what they make a guy who's running around asking the hard questions look like a lunatic because he's got to do what's called ambush journalism. Why can't he be a real journalism and just listen to the drivel that they feed you?
I mean... It's back to when we were talking years ago. Remember with Ron Paul and how he made too much sense. right?
Yeah.
And he basically talked about, ending the Fed and destroying the Fed. His book that came out about it had a lot of press. He got a lot of press there for a while, and then all of a sudden he just got buried, right?
Yep, and the idea is about the Fed is not whether there should be a Fed or not, but whether they should raise rates or not. That's what the debate is. Not why do these guys have the ability to control the price of money for the entire country and perhaps the entire world.
Right. Yeah. And, if I remember correctly, I read the book In the Fed by Ron Paul. And anybody that hasn't read the book, I highly recommend you guys read it, because I think you will have some deeper insights into the Fed and what they were created to do. But right at the beginning of the book, he talks about the old definition of inflation. What is it, Lewis? It's an artificial increase in the money supply.
Increase in the money.
Right?
Not even artificial, just an increase in the money supply is inflation.
Yeah.
What the Fed does is does it artificially because they have the monopoly on the ability to create money. You could have inflation in the old days if they just found, if gold was money and they found more gold in a mine or silver in a mine in South America and brought it back to Europe, well, that's inflation. There's an increase in the money supply. There's nothing insidious about it. It's just something that happened.
But yet
that's natural.
But yet we've increased the money supply by some ridiculous amount. But there mysteriously isn't any inflation. There's none of that, really.
Well, but there is. There's inflation in the money supply, but it's not enough to combat the deflationary pressures which are created by the last bubble bursting. And that's what they don't understand. They keep saying we have no inflation. Well, we have inflation where that increase in the money supply went, but we don't have inflation everywhere. And we really should be having significant deflation. So all that money flowing in the system is doing is offsetting deflation and inflating things like asset prices, where the money goes. I mean, the stock market is well inflated, so are housing prices, so are food and energy costs.
Well, I was reading somewhere the other day, and these numbers could be sort of off because I'm trying to remember what they were. But supposedly there's only really, for the amount of money that's actually out there, it's only 7% cash. And 93% are zeros on computers.
Right, and 60 to 80% of that cash is overseas, the actual physical cash. So the amount of cash is low to begin with on a percentage basis, and most of it is overseas. And that's from the Fed's own documents. I saw that. That's not me making it up or guessing.
And that's why our idea a while back of basically the Fed just taking and giving money to every average Joe on the street, just giving them cash. It's a bad idea, right? Because they know what would happen if you flush the entire country with cash. We have a big problem then. And
how many people would save that money? How many people would invest it? I don't mean in the stock market. I mean in a productive asset.
I mean, you're talking about 1%. 1% of the people.
Exactly. If you gave it to everybody, the people who already know how to make money would just take that as an additional piece of capital. Everybody else would run to Walmart with it. Or if they needed the money, they wouldn't pay down their debt. They would just buy more stuff and figure, well, okay, I have more money on my credit card to spend.
Right. Yep. Yeah, and so, I always get the question of, okay, so, I'm not making any money in my bank account because interest rates are low. I can't get a mortgage. Stock market's moving higher, so what am I supposed to do? And I'm not a financial advisor or anything. Unfortunately, you pretty much should probably follow in line with what the Fed has been doing for some time now. Now, why that could be dangerous? Because in a moment's notice, it could all come crashing down faster than you could probably push a button to make a stock trade, right?
Yep.
And that's where
could happen today. Could happen Monday.
And it would make sense that it would happen, right, Lewis? It would make sense because if you look at everything that's taking place, if we look at why the stock market is where it is, and if we look at why the interest rates are there, where they are, if we look at why the huge debt that this country's accumulated, I mean, all these things show that we shouldn't have a stock market where it's at. We have no wage growth. Employment situation in general is terrible. The amount of people that are on food stamps is ridiculous.
Companies' revenue growth doesn't correspond with their profit growth per share.
Not at all.
Because they're buying back shares. Companies buying their own shares back to reduce the float, make the shares make the share price look higher per share.
If these shares weren't moving so much higher, they wouldn't also have the capacity to turn around and buy up company after company after company, right? I mean, if the stock market has been increasing for some time now, which is really, for the rich, it means they get richer, but for everybody else, it really doesn't mean much. And the middle class is being effectively wiped out with this the last 6 years. Would you agree, Louis? I mean,
they show it. I think we mentioned last week, from 1989 till now, the middle class is making less money per average or per median per household, from $56,000 to $52,000.
Yeah, and
those numbers don't lie. I mean, it costs people more money to send their kids to college. It costs more money to buy a house, and they cheer on housing prices as if that's a good thing. It just makes them more affordable,
right?
And more unaffordable.
And you know what I've never understood, and I always talk about the eye test is that you wouldn't actually have to talk about the real estate market doing well. It just would be doing well, right? Like, there's nothing, if you're having to hype something, that typically means that there's a problem.
Yep.
You know, and there's no hype needed if there's wage growth, if there's consistent employment history.
And who's doing the hyping? Who's doing the hyping? Reuters, AP, certain journalists, CNBC, people that are in favor of the current administration. Those are the
reporters that you were talking about again, Louis. Those are the ones that will ask the questions, and when they ask difficult questions, they'll just let it go, right? Those are those guys. Those are the ones that will basically report as basically the Fed wants them to report, as the president wants them to report, as Congress wants them to report.
And they're the ones who, unprompted, will go on these gold bashes just because they woke up in the morning and they decided it's time to have a story about why gold should not be considered a monetary asset, why people who buy, there's something, it's the it's almost like on a group of people, an ad hominem attack that somehow you're crazy to want to own that. Just look at the stock market. You don't see stories about how low can the stock market go. And when they do have those stories, if you think about it, the people that are presenting the cases for lower gold are always viewed as, well, these are the sensible people. But when someone comes in talking about lower stock prices, they get monikers like Dr. Doom. People that are kind of considered out of the mainstream because they don't believe that stocks are properly valued. They have some conspiracy theory that they're overvalued, that they're not worth what they are. Don't they understand that the price of the stock market is self-validating because it's higher, therefore it must be a valid, but they didn't, it must be a valid price. They didn't take that view when gold was up to 1900. In fact, they ignored gold. It went up for 12 years. No asset goes up for 12 years in a row. Okay, that's the story of the decade. When an asset goes up 12 years in a row, and they don't mention it. Of course, the minute it goes down a couple of points, then they're all over it. And then anybody who bought it was an idiot. They have their tin hat on, their conspiracy theorists.
And see, and the whole gold-silver thing, which we tend to talk about a lot, is what gives many analysts and economists and all these people out there the reason to always say, well, if the dollar, was crumbling and if the economy was really crumbling, then we would see gold and silver prices higher. Yeah, that would be true if we didn't have manipulation of those markets as well, right? And so when there's manipulation of every market, I mean interest rates to gold and silver to the stock market to the bond market to the LIBOR to treasuries and everything else, it's impossible to say what is, and we know what should happen, but since it's completely rigged, it's going to happen the way the Fed wants it to happen. And that's why we've had consistent increases in the stock market and steady, basically, gold and silver prices. It's not decreasing. And it makes no rational sense. I mean, we know what should be happening right now, Louis, is that, gold and silver should probably be through the roof. The stock market should be falling. But that's not what's taking place.
Right. And why is that? Because of direct manipulation. So as they say, they are on record. They've admitted that the reason they keep interest rates low and they have zero interest rate policy, they've done QE, was to promote an increase in the stock and the real estate market. They're basically saying we manipulate markets for that benefit to have that happen. Yep. But yet, it's considered ridiculous to think that they would manipulate a counter market downward in order. Of course they do. They can't have gold rising if they want people to believe in the fiat currency that they're printing. They can't have that. So they use the fiat currency, which they can print in abundance, to knock down the price. I mean, that should be obvious. That's not a conspiracy theory. If they were already on record as saying, if they were saying we believe in free markets and they don't do anything, then you say, well, that's kind of crazy. Why would they go after gold and silver? Well, the fact that they're going and trying to boost intentionally, publicly, the stock market, intentionally, publicly driving rates down to drive up home prices, and to say this is good for everybody, well, if you want that to be good for everybody, if the counter is bad for everybody, which is rising silver and gold prices because they indicate maybe we don't like what you're doing, then of course they have to knock those down.
Right. And you know what CNBC and MSNBC and all the other stations would tell us, Lewis? They would say, Ryan and Lewis, you guys are crazy. The only reason that you guys are saying this is because you've got money invested in gold and silver and it's not going up.
Right. Well, that was the argument that this Ritholz guy, I had a Twitter exchange where he said, how much are you underwater on your trade? Well, first of all, it's under his business. Second of all, I'm not.
Right.
But the point is that's what they want you to be. They want you to say, well, because I've lost money, you got to ask yourself a question. There's this paternalistic mentality. Why do you own something like this? If the world isn't ending, the economy is improving. They throw out all of these self-fulfilling statements that the economy is improving, everything is getting better. You made a mistake in having gold. You missed out. And that's the mentality they want to put forward. Now, if the stock market crashes, what are they going to say? They made a mistake. They should, it's kind of ludicrous that they come up with these arguments when asset classes are asset classes. They're not meant to be some type of emotional game. They're not meant to be kind of cheerleading. You own an asset because you own an asset because you think it's going to go up or you want to retain value. That's it. It's not about, maybe for some people it is. Like for Bitcoin, it's a political philosophy. But when you buy a stock, they always tell you, if you buy, don't fall in love with the stock. You're not supposed to be an Apple fanboy, because if you are, that's how you're going to lose money. You're not supposed to be a gold bug, meaning that you think you adore gold, because if you do, you're going to lose money because you won't see the point when it doesn't make sense to own gold, like in the 1980s. Any asset. But they try to bring it down to the level, not of financial analysis, but to the level of personal analysis.
Right.
And that's not really good journalism, if you ask me, because if you're really trying to raise the level of the discussion, you want to talk about not it's going to 600, it's going to 200, stocks to the moon. That's just silly talk. You want to talk about fundamentals that you mention all the time, Ryan. There are no fundamentals. It's just manipulations. Right.
Yeah. And when you essentially have mass manipulation, what tends to happen is that everybody has to kind of follow suit, right? And so they've been following suit with the Fed's every move, interpreting the Fed's language and for 6 years now. And it's no coincidence that, we are where we are right now. With the stock market high, with basically a low interest rate environment that nobody can take advantage. And so they can continue to confuse people because they can always resort back to the only thing they can hang their hat on, which is that we have a low interest rate environment with a high stock market. Okay? And so it's great, yeah.
And if you don't understand low interest rates, we have a high stock market.
Exactly. It doesn't matter whether you understand low interest rates and it doesn't matter if you can't get a house because your stock portfolio is still high. That's assuming you have one. That's assuming you have a retirement account. That's assuming you have any of these things. But I think people are too quick to forget because the last time that the stock market crashed, most people lost about 50% of their portfolio, if I'm correct, Lewis.
Yep.
And don't think that
it's going to happen again. There's no way it's not. The fundamentals don't support the market.
Right. The fundamentals that we don't have. We get these stories now, and I think it's comical because, I'm watching this, and I always tell people that I could care less about what the numbers say. I could care less unemployment, all the numbers that come out. We talk about them on this show because it's a necessity because, once again, we're trying to take the information that's given to us and break it down, right? So we have to do that, unfortunately. But I'd rather not read the crap, to be honest, Lewis, because you and I could almost, without looking at the news, tell what's going to happen, right?
Right.
Because it's that predictable. But
you had to have that. You had to have that job number come in really good yesterday to offset the gloom and doom.
Of course.
Because the Fed can never be seen as decisively, inexorably heading in one direction. They have to get thrown off course.
Exactly. What happens when the 10-year note starts going too low? we've got to get that going back the other way because we can't have interest rates drop down too far. You know what I mean? So it's highly
same with the dollar.
difficult.
The dollar was, if they really are going to raise rates and they're going to stop QE, of course the dollar will go higher. If the rest of the world is printing money and at zero or negative interest rates, the dollar would soar. They can't have that. That's deflationary.
Right. So, now I'm getting all these stories where, student loan debt affects younger adults' ability to get a mortgage. We've been talking about that for how long, Louis?
For 3 or 4 years. Now that's like some genius woke up, rolled out of bed and said, wow, these kids have loans and they don't have jobs and they owe money? That might be a drag on the economy. Let's print it in CNBC or Bloomberg.
Right, because you know why?
And everyone reads it and goes, wow, that guy knows what he's talking about.
Right. You know why? Because real estate, has become that back page news. So it's like now the reporters are trying to figure out, what's going on. Oh, so maybe the recovery has stopped now. There never was one.
But it's not because of Fed policy. It's there's something wrong with student loans, and we got to do something. We need Lizzie Warren on the case. We need her to tell us that there needs to be more government programs to help these people and forgive their student loan debt or give them more access to loans so they can borrow more money and give them job training. She wants to exacerbate the problem.
Well, you know what? And it's right back. You're 100% correct. So I talked last week about how there was a potential bill that's going to get passed that if somebody goes and works for the government, that basically their student loans will be forgiven, right?
Right.
Okay. So think about this. So we have that. We also now have Bernanke that couldn't get a loan, which I guarantee is somehow going to turn into something, either loosening regulations or, creating more aggressive lending programs. We also have, which we talked about on the show a while back, that they're potentially changing the credit scoring model, okay?
Yeah.
Because now that people can't get, mortgages, maybe we need to adjust the credit scoring so that the scores go up a little bit. That might help people get loans, right? So they're going to have to continue to, deregulate and or just allow more aggressive programs to try to get more and more people to be able to borrow money. But the unfortunate part is that they still can't fix the biggest problem of all, which is that the jobs, there are none. And
you need a job to have money, to save money, so you can invest your money, and so that the economy can recover in a real way. You don't just give people money and hope the economy recovers. Worse, they don't even give people money. They give people access to credit, to money that they don't have, but they're still going to have to pay back.
Yeah, how many people question the Fed and or Congress or anybody else about how many people are really on food stamps right now? How many questions would get thrown out about that? Not too many.
No, they won't. They think that's good because in the words of Nancy Pelosi, these programs create jobs. Economists will tell you. Yeah, economists will tell you that they're good for the economy. Because what do they do with the money? They spend it. I mean, here's an ignoramus who's telling you that food stamps are good for the economy. If that were the case, then everybody should just quit their job and get food stamps. How ridiculous. Right. It's the same argument that you have to have a minimum wage because that's good for jobs too. Because what are they going to do with the money? Now they have more money. They're going to spend it. No, they're going to be fewer jobs, and the price where those people work for the products they deliver are going to cost more.
Yeah, anytime
you can't just wave a wand in one area and all of a sudden you fix someone's economic problem. You just create a ripple effect somewhere else, and you harm some other aspect of the economy.
Yeah, well, I mean, anytime.
It's not natural.
No. And you know what happens is anytime, there's any sort of private business taking place, whether it's green energy or anything that they come out with, the minute that the government gets involved, what happens?
Price goes up.
And it self-destructs. Okay? It's
good intentions, but they don't understand it doesn't work the way. Just because you want something to be and you want to change the world, that's not how you do it.
Right, and then you want to find a way to make money off of it, and by over-regulating and doing all the things. I mean, it's no coincidence that the mortgage applications are down. It's no coincidence that people get turned down for loans, even some of the people that have jobs, Louis, because there's so many literally intricate things that have to take place now in the loan process, and if a loan officer makes a mistake somewhere in that process, that person's loan could get denied. Now, that doesn't mean that person couldn't go to another lender and maybe get the loan because it was the loan officer that made the mistake. But literally, this is how compliance and the regulations have changed these industries so that the low interest rates don't matter. They don't matter.
Nope. No, because you say week in and week out. If these rates were, if you had low rates like this in a normal economy, the housing market, not the pricing, forget the prices, the volume of sales, it would make so much sense for everyone to just, hey, I got a job, why not own a home? The only people that wouldn't own a home were people who, for whatever reason, are either mobile or they thought that they didn't want the responsibility. But for most people, I say most, I don't mean it as a generality, I mean 70, 80% would choose to own a home at a decent price if they could afford it, and then the mortgage rate was low. Why wouldn't you? Got to and they give you a government tax reduction for the interest that you pay. Why wouldn't you do it? Now, some people, there are reasons not to do it, but for most people, they would do it. And they're not doing it because they can't.
You know what's funny, though, is the way they rationalize why the young people aren't buying now is because they watched their parents go through the whole, bubble bust, right?
Another point you and I made in 2010, 2011.
Right. They've watched them, get kicked out of their home or have to short sale their home. But you know what? I think the real reason is that they're overburdened by student loans. They don't have a stable job. They're not making enough money. They've got, healthcare benefits that have gone up. Food and energy prices have gone up.
And culturally, all their friends live at home, so there's no stigma attached to not owning your home. Right, all these points that you're mentioning, we mentioned years ago. We mentioned the stigma of people. We mentioned cultural changes that would take place if this lasted 5 years. Well, it's 5 years later since we started talking about it. It has lasted 5 years. Yep. People they keep talking about household formation as if they keep talking about historical household formation trends mean that this year no. Just because in the past people formed households at a certain rate doesn't mean that this generation is going to form them ever at the same rate. But they've used models for that. They've insisted that that's what's going to happen. Then when that doesn't happen, they have to blame something else. Oh, maybe they have student loans. Yeah, okay. Thanks for noticing that, too. Maybe if their parents can't even get a mortgage, why would their kid be able to get a mortgage? Maybe it has something to do with that. And, maybe there is. Why own a home? It's too much of a hassle. Here's the other thing, Ryan. When you go for a mortgage, it's like an IRS audit. And some people don't want to go through that.
That's pretty much one of the complaints that I hear day in and day out is
that, like none of your business.
Yeah, well, I don't understand. Why do I have to provide that? Well, the answer is that the company that's lending you the money can ask you for whatever they want in order for you to get that money, right? Well, that seems a little intrusive. Well, unfortunately, the company that's going to lend you that money can ask you whatever they want, right?
Sure,
it's like,
but it's not the company, right? Because it's the government. Because these loans are all government-sponsored loans.
Well, and because they're going to be sold off to a GSE, right? So
Fannie and Freddie, government-sponsored.
Fannie and Freddie,
right.
and it's the same thing. If you want to get on an airplane, you're going to go through that security, right?
Yep.
You're going to go through it. So it's the same thing. But, yeah, it's become such a difficult process, and I think people actually are just, they're flat out scared to turn over basically what feels like you're going through the scanner at the airport, because that's basically what it's like.
Yeah.
You know what I mean?
It's basically it's an X-ray of your financial life.
Yeah, and I think, I think one of the biggest hurdles is for anybody to feel like that they're not worthy of getting a loan, right? Like,
right.
That would give me pause and hesitation if I felt like I was going to be denied for a loan. I just wouldn't apply for one. Wouldn't you feel the same way, Lewis?
Oh, absolutely.
And I think that's one.
Especially if you thought there's a good chance you're not going to get it.
Yeah.
Like if they told you may or may not get on the flight, but we're going to strip search you, do cavity searches, we're going to put you in a holding pen for 3 hours, put the spotlight and answer your questions, and we might let you on the plane, you think, I'm not going.
Yeah, and let's just say that somebody applied for a loan 2 years ago, Lewis, and they got denied. But now they've got a stable job, but they were so turned off by the process the last time they went, they just said, you know what, I'm not even going to mess with that. I'm just going to keep renting. I don't need to buy a house. So,
but you know what they love, Ryan? They get that letter in the mail. Here's your credit card. They'll take that.
You know why? Because it's automatic.
That's what I mean. You don't have to do anything.
Yeah.
You don't have to send anything in. You just get it, and you start spending. And because you do that makes it even harder for you to get a mortgage because now you have more outstanding consumer credit.
Yeah, and isn't it ironic, Lewis, that those automatic credit offers are at very high interest rates? No coincidence there, right?
That's criminal. Of course. Yeah, that's market. When the price of money is cheap, you can't get it, And when it's very expensive, they give you as much as you want. 18%, you want to pay that? Here's your card. I mean, Milken figured that out long ago with the junk bonds. Yep. That even with the high default rate, you still make money hand over fist when you have that high interest rate.
Oh, absolutely.
Because if just a few people pay at the exorbitant rate, you can have a default rate of 20, 30%, and you're still better off than loaning zillions of dollars at 1% with a very low default rate, because you don't make any money on the 1% interest.
Yeah, well, it'll be interesting to see. I'm willing to still bet. Here we are, October 10th, 2014, Lewis. So 2 years from now, October 10th, 2016, will we still have interest rates in the 4% levels?
I would have said no, but now I'm saying, after seeing what I've seen, what they've done, probably yes. If they have anything to say about it, and they seem to have as much to say about it as they want.
Yes, and as long as Obama...
Will the market overwhelm eventually? That's the question.
Yeah, and
But then I say, what market?
Yeah, well, you know what? We're going to save this clip right here. We're going to come back 2 years from now, and we'll see how it all plays out. But there's one thing that I think, it's going to be somewhat close to where we are right now. If they don't really have any options, right? And barring another major catastrophe.
Or outside, we've said this too. We've always caveated that if Russia or China were to be serious and decide to throw over a lob and say, you know what, we're tired of this, and we're going to take control. We're just going to say the price of, just like the United States did in 1933, they just said the price of gold is not $21 anymore. We've taken it back from our citizens, now $35. Something like that. China can say, you know what, gold is now $2,800 an ounce because we have a lot of it now, so we want it to be $2,800 now. Russia can say something like that. They could say, you know what, we don't take dollars at all. That's where the Fed loses control. That's where then everything is out the window, because then they don't control and dictate what the terms are of money and what goes on. Then everything collapses. Yeah,
and I think that is a definite possibility of happening. The question is when. I would say, I think we're in probably like a 2 to 5 year range. But
well, why wouldn't China do? I mean, if China and Russia accumulate 5 times more gold than they had a few years ago, and they realize that the value of the reserves might plummet because they're subject to them being held in dollars, and they want to kind of rebalance, and you say, well, we'll never get enough gold to offset the $1.5 trillion we have in U.S. Treasuries, but if gold would be $8,000 an ounce, well, then we'd be okay if we lost money in our treasury. So tomorrow we decide that that's the price of gold. And if they have a large market, now you've created chaos. The U.S. markets can say, the London markets can say, no, gold is $1,200. Okay, and what do you think people would do immediately? They would sell their gold to the East. And if the East had the gold, what would happen? The more they have, the more they can control the price.
Right.
And if they had more gold, then the price would go even higher. So something like that. I'm not saying that's going to happen. I'm just saying they can decide where no one could have ever decided. If you remember back in 1971, after Nixon went off the gold standard, he just said, screw it, we're not going to pay you in gold. You can do whatever you want, but the dollar is still the reserve currency. Connolly, the then Secretary of Treasury of the United States, met with the G6 or 7 or 8, whatever it was at the time, leaders. He said, it's our currency, it's your problem. See ya. I don't think you can do anymore.
Right.
There was news yesterday saying China was now the number one economy. I don't know what I didn't get to read the story. But the point is that the United States is not the dominant sole super economic power in the world as it once was. So that's where everything they want to do, they've been able to do, but I don't think they have the same ability to control it if China and Russia, because they know they hurt themselves if they do some of these things. There's unintended consequences, so they're not going to be rash and just say, well, we've had enough, and this is what we're going to do.
Yeah, I agree. Only time will tell, but the one thing that will continue is the mass manipulation. That's one thing you can bank on.
Oh, it's essential. In order to maintain, it's even more essential now than it was 30 years ago, because the United States has to create the dominance that it doesn't have through manipulation.
Absolutely. Okay. And, we'll keep plugging along here, Lewis, as we do week in and week out. We're up on the end of the show here. But give our listeners your blog so they can check out your blog post, please.
Thank you, Ryan. It's at smallgoal.com. And Ryan mentioned it. I don't think you mentioned at the start of the show. You can also get the show on iTunes. If you go to Real Estate 360, you can get the show. You can go to Real Estate 360. Is it realestate360live.com?
Yep, you got it.
You have the shows listed. If you go to Small Goal, you can receive blog posts. You can subscribe and get the latest blog posts that we put out 1, 2, 3, sometimes 4 times a week. And we also carry the shows, the Real Estate 360 shows, on YouTube format on the smallgoal.com site and also on the Small Goal YouTube channel. So please check that out. Thanks, everyone, and thanks, Ryan.
Thanks, guys, for tuning in. We'll be back again next week. Don't forget, download, subscribe, share with your friends on iTunes or on the website at realestate360live.com. Take care. Until next time.